Okay, hi. All the peoples. All right, so I promise I will start here. First things first, you'll notice I'm a redhead. I promise I'm not boring. Okay, I get it. Taxes are not the most interesting subject for a lot of people, but for all of your business owner clients, for all of your real estate investor clients out there, taxes is a big thing, right? The average tax bracket here in the States for people that are buying and selling homes is somewhere around 38%. That's just income tax. That doesn't include the self-employment tax, all right? And for you guys as agents, your average is about the same, 38% plus another 15.3. So you're easily paying over 50% in taxes. Who would like to know how to not pay 50% in taxes? Hey, we're in, right? Okay, so that's one of the things that we're here to talk about today. I absolutely love Q&A. Love it, love it, love it, love it. So please, if you guys have questions, stop me, ask me. I know we only have 20 minutes, so I'm going to talk pretty fast. But, of course, I'll leave a stack of business cards. If you guys have any questions whatsoever, TaxGoddess.com. Tax Goddess, super easy to find. I'm everywhere. TV, radio, you name it, we're everywhere. So just a little bit of background on me. You can see all the initials after my name. So I am a CPA, Master's in Taxation, Certified Tax Coach. There's only 500 of us in the country that do the tax strategy that I do. And I'm also a Certified Tax Specialist, which means I'm in the top 1% of tax strategists in the country. So this is my gig. This is what I love doing, is tax strategy, okay? So really what we're trying to do is get the word out there to small business owners, right? You guys are all small business owners, right? You run your own little practice, right? So trying to get the word out to small business owners that you don't have to pay, who was it? You said the bare legal minimum, right? I want to pay only what I absolutely have to, not 1 cent more. Man after my own heart. I love it, I agree, we're on it. So that's my job, is to help you guys make sure that's what's happening, okay? Published author, you can find me on Amazon, Tax Goddess Guide to Starting Your Own Business, Corporate Specialist. Now, every once in a while, you'll hear me make references to being a tax Jedi. I love Star Wars, okay? You'll hear me talk about the dark side a lot. I wonder who I'm talking about. So anyway, just random notes there. All right, who's in the crowd? I think I kind of know you guys, but real estate agents, right? That's who's in the crowd. We've got, everybody's here as a business owners. You guys specialize commercial, residential, everything? Commercial, residential? Residential. Okay, so I'll try and cover both ends of that because there are specialty items on both sides of that. All right, tax reform. One of the biggest things you guys need to know, and if you haven't heard it about yet, your head's been under a rock, right? December 20th, there was a massive tax reform. And when I say massive, I mean they changed over 60% of the tax code. 60% of the tax code changed. Now, from a purely business CPA standpoint, every change they made has been extremely helpful. Huge thumbs up to our government for making the changes they did. It helps business owners to no end. Individual taxpayers, okay, if you're just a straight up W-2 individual taxpayer with no business, you kind of got hurt by some stuff, okay? Not in all cases, but in a lot of cases, there were some downsides to that. So for your residential agents, if you guys are talking to your homeowners, that kind of thing, I mean, you guys know better than to give tax advice, but make sure you're telling people to reach out to their personal CPAs. A lot of individual taxpayers aren't ready for the hit that is going to hit them when they go to file their 2018 tax returns next year. Okay, so you guys can actually look like a hero suggesting to them to call their CPA, just make sure everything's good, right? So they're prepared. If we can give them a year in advance to help them understand that these changes are going to impact them, it's good for everybody. Now, on the commercial side, all of your commercial investors, I'm sure, have the biggest grin they've ever seen on their face because of these tax changes, right? So we're going to go over some of these changes, how they impact you guys, how they impact your clients, all right? So the corporate side, one of the major changes that they made on the corporate side, C Corp's maximum tax rate used to be 35%. It has dropped to 21%. This is huge, okay? Definitely pro-business. You can tell, right? They cut 14% right off the top. Depreciation, this is one of my favorites. So whether you're on the residential side working with investors, right? They're buying rental properties, they're doing, well, fix and flips is something different, but anybody holding property, depreciation on assets under 15 years doesn't really exist anymore. You can now write off things up to 100% if the life of the asset is under 15 years. So please, guys, remember, ask me questions if I'm not being clear on something. One of the major benefits for investors in real estate is something called cost segregation, right? And really what it is, let's say we tear apart this building, the flooring, well, concrete, this might last 15 years, but the carpet is only going to last 7 years, right? The glass doors may last 5 years. Cost segregation means that you're actually pulling apart the purchase prices of a building. Now, you can do that in commercial buildings. You can also do that in residential, right? So for your real estate, your long-term buy and hold rental people, cost segregation is going to make a massive difference to their tax bill. And anything that is under 15 years of life, they now get a 100% write-off in the first year. So if any of you guys are working specifically with real estate, like long-term hold rental people, cost segregation and this new depreciation rule is going to have a massive impact to their bottom line. We've seen cases where, for example, a $250,000 home purchase, they're now partitioning out with cost segregation $50,000 in the first year of write-offs against, for example, let's say the husband's in real estate, the wife has a W-2, they can actually write it off against the W-2 income. Big changes. These are really, really helpful. Okay?
That's the C Corp?
No, actually, that is just anyone, period. So if you have a rental property, like a residential rental or a commercial rental, get that cost segregation prepared early. The cost segregation experts are actually getting swamped because of this rule, right? The guys that we work with are now about 7 months out at this point for preparing.
So, Kelly, you own this condo? Or you lease it? So you can cost segregate the condo and everything in it gets depreciated on a much quicker scale. Saves you a lot of money running. How quicker is it? How much faster?
So the old rule used to be 5-year, 7-year, 10-year, right? So normally when you buy a commercial suite, it's 39 years. Everything is 39 years. But if they do cost segregation, it's going to break it down into 5-year, 7-year, 10-year, 15-year, right? And the great part about it is 15-year and under, you now get, under the new tax law, you get 100% of that right away. So this is huge. Major savings.
What's the cost return? I looked at one of them before. We were going to spend $25,000 to get it done on a bigger property, but we were going to get a value of $250,000.
Correct.
So,
yeah. And typically, you know, one of the things that I really like about the cost seg, guys, again, you're right, it depends on the size of the property. If you're talking about a hotel, it's completely different than a small residential, right? But even your $250,000 residential property, you might spend $2,500, $3,500 getting the cost seg study done, but your tax savings in the first year might be $10,000 or $15,000. So they normally, the good cost segregation companies will give you a quote up front. This is the estimate, so you can make the decision whether you want to proceed or not. Cool. Okay. All right, the next one, qualified business income. All right, so this is a strategy. Let's talk about this. Now, QBI, it's shortened into QBI, all right? Basically, there are two different segregations of income, all right? So there's this 50, 100,000. So if you're single, it's 50. If you're married, it's 100,000. So there's under that figure and over that figure, all right? Now, how many of you are married? Okay, so for those of you that are married, you not only have your income, but you also have your spouse's income to qualify for this number, right? So if you're married and between the two of you, you're making over $100,000, this does not work for you. But why is everyone in business? From the tax standpoint, to get write-offs, right? We get to write off our cell phone, we get to write off cars, we get to write off home offices, we get to write off our kids. If anyone has kids, we'll talk about that. Those little things are fantastic tax deductions, okay? If they're 7 and older, we'll come back to that. He's like, yeah. Super excited about that one. So what the QBI is, now this is, the QBI itself is not the tax strategy. This QBI is now a new part of the law. If your income as a family, right, so either as an individual or married, falls below one of those two numbers, 20% of your gross income is not taxable. 20% of gross. Okay, so if you make $100,000 gross, you have $50,000 in expenses, your net is $50,000, you're a single person, 20% of that 100,000 is now a tax deduction. You went from 50 minus 20 down to 30. You are only paying tax on 30% of your income. Huge, okay? So what is the strategy here? Because it is what it is by the end of the year, right? No, right? What you guys really want here is to get your actual net income before you run this calculation down below the $50,000 to $100,000 number, okay? Now you'll notice here that I've got an exception, right? Ineligible for service partnerships unless you're under that income, okay? So it all comes back to that income number, that 50 and 100,000 income number. Any questions? Please. Married filing separate, you'd be at 50. Yeah. Yeah. So potentially if the wife doesn't make anything, you know, that might work too. Great. Okay. Rock on. DPAD especially impacts your investors, your construction people, anyone who was producing anything, okay? Manufacturing, this kind of thing. The DPAD, which was the Domestic Production Activities Deduction, is now gone. It's been repealed. It's been replaced by the QBI. All right, so if you had anyone who was taking that deduction, sometimes I think you guys might see tax returns. You know, they're talking to you about how do I get a mortgage? What am I doing? Who's my mortgage person? You might see DPAD. That would be one of the things you may want to bring up to your clients. This no longer exists. All right, it could jump their income. It could tax them even more. So again, one of those things to tell them, please check with your CPA, right? If I can't drill that into your heads enough, right? Check with your CPA, right? Can everybody repeat? Check with your CPA. Yeah, okay, got it. I got to at least try, right? I have seen too many agents, I know that, I know the DPAD, I know the deduction, and get themselves in trouble, right? Last thing you guys want to be doing is talking anything about a field that you are not an expert in. But you guys know that because you guys are awesome. Otherwise you wouldn't be here with Kelly. Problem solved, right? Okay, fantastic. The last one is the move to a territorial tax system. So this may or may not apply. It depends on what kind of investors and people that you guys are really working with, all right? So one of the major things that used to happen was here in the US, right? I am a US citizen. If I earn income in Thailand, for example, I have to pay tax on my worldwide income. Okay, if you have investors that have foreign investments, this is now moved to a territorial tax system, which is a big shift, again, in the taxes. So if you're working with foreign investors, make sure that you're talking to a CPA that understands the foreign, we get a lot of Canadian and Mexican investors coming to the States. This could apply. So just make sure that you're checking with them. And again, your CPA, right? You're working with a CPA that understands these things have changed.
Does that change with active duty military?
I'm so sorry, say it again.
Active duty military that's overseas making money, does that change?
That one does not change. You're still considered on US soil when you're on a base. Yeah. Good question, though. Really good question.
Shauna, along those lines, this is
Please.
kind of a sidebar, can you explain really quick birth death?
Really quick? No. Really quick, the answer is no. No, but I would be happy to create a blog post for you guys.
Perfect.
Okay, so Kevin, if you wouldn't mind emailing me and I will get that done for you. It might be after tax season. Sorry, guys, I hope you understand. But yes, I will get that done for you. Really quick, the answer is no. Tax reform, any questions on the business side before we go to the individual side? Nope, okay. So switching over to the individual side, the highest tax bracket is now 37% from 39.6, 2.5%, nothing to sneeze at, okay, but it's still 2.5%. This is where people are going to start getting into problems, okay, is the standard deduction. Now, of course, the media made it out that the government did this huge positive thing for individuals, right? They doubled the standard deduction. Sounds amazing, unless you have children. If you have 3 or more children, this actually ended up hurting you. This particular section that they changed in the code, this hurts you. What they did do was they doubled the standard deduction, but they removed the personal exemption. So, yes, one section went up, but if you have 3 or more children, it went down. So if you're working with anyone with big families, right? I've got a client with 8 children. This actually increased their tax bill by about $16,000. They were not pleased, right? Everybody, the media put it out there that this is going to be amazing for individuals. Absolutely not, okay? Now, if you only have 2 kids, it kind of works out okay. If you have 0 kids, good on you. This works really well, okay? Now, one of the other things that you'll notice here, say it again.
Trying to push birth control?
I'm not getting into that topic, but there you go. No, a lot of kids. So the other thing, and this is more where you guys as your investors are going to really see the pain, especially people moving here or who have their primary residence in high income tax states like California, New York, right? Any of these states, New Jersey, where the income tax rates are really high. The SALT deduction, it's the state and local tax deduction, and they shorten it to SALT. This has now been capped at $10,000 per year, okay? Now, that doesn't sound like it would be a major problem, but when you pay income taxes to the state of New York and you're paying $50,000 in income taxes under the old law, that $50,000 was a deduction at your federal tax return. Now it's capped at $10,000. This is where people from high income states are really going to get hit. They're really going to have problems. So, how does that impact you guys, right, as investors? What about people actually moving their residence to a lower income tax state? Arizona, Wyoming, Nevada, right? Some Florida, where they have no taxes at all, Texas. So you're going to see a lot more investors coming to you from these 0 income tax states because effectively they're getting bit. Their tax bill just went up by $20,000 because the taxes that they did pay are now no longer deductible. Big issue, okay? So the SALT deduction covers state income taxes, local income taxes. It also covers property taxes, which is a big one. There's a lot of states that are actually having discussions right now about switching the way that they manage property taxes to get around the federal law, all right? So we should be seeing some changes in the property tax section as well. Any questions so far? I know I'm starting to get technical and detailed. I promise I'll try and keep it interesting. 1031, the next biggest thing. How many of you guys have heard about the cryptocurrency millionaires? Everybody's at least heard? Okay, 2017 was the year for cryptocurrency millionaires. If any of you guys have actually watched the Bitcoin prices, right, they spiked way up, they dropped way back down again, right? Cryptocurrency people tend to have, or had a lot of money, and if they didn't sell at the right time in the market, they now have these massive tax bills with no money to pay it. Bitcoin is now worth, what, $7,000 on the open market? It was at 19.6. It's dropped again since 2 days ago when I checked it. I mean, it's insane, right? So one of the things that if you guys are dealing with any of the cryptocurrency people, you may hear them talk about 1031 exchanges. Now, the IRS has specifically come out and said 1031 exchanges only relate to real estate starting January 1st, 2018, which is great for you guys, right? But if you're talking to someone who, hey, I'm a cryptocurrency person, I've got all this money, and yeah, my CPA said I'm going to 1031 it, red flag. Cryptocurrencies cannot be 1031'd at all, does not happen, not post 1/118. Okay, so I like to bring that up because we're seeing a lot of these cryptocurrency millionaires come in. They want to transfer the cryptocurrency security to real estate property. It's no more.
They'd have to find other investments then?
Unfortunately, the IRS is strictly forbidden now 1031 with cryptocurrency at all, period. They are looking at it actually as a currency rather than a security. So yeah, cool. Okay, next one. This is a big one, but you guys are potentially safe from this, I think. No more 2% floor. So how many, I know some of you guys were married. How many people have W-2 people in the family? W-2, we got a couple. Okay. Nope. He's like, nope, all 1099. 1099 is good. So W-2 people, you bring a box of donuts to work, right? Technically, that is a business expense. You are helping your coworkers gain a little pot belly, whatever, right? But it's a business expense. Under the old rules, you were allowed to deduct that as a business expense, okay? Now, that is gone. The 2% itemized deductions are now gone. Unreimbursed employee expenses are gone. So you guys, because you're all 1099, right? I think, except maybe your admin staff, but yep, you guys here are all 1099. You guys have the rock star perfect position. right? You can get yourself down to that QBI level, that 50 or 100,000, hopefully, right? If you're making way much more than that, we'll have to find a different tax strategy, right? But if you can get yourself down to that, you still have the ability to write off your expenses. Now, one of the most common ones that we see, even for 1099 contractors, is their tax preparation fee is still listed on Schedule A under the 2% floor, right? Brokerage fees, financial advisory fees, legal fees, CPA fees, these were all 2% floor. So if you guys are working with any of those types of professionals, make sure that you're paying them through your business, please, right? If you're not paying them through the business, you've effectively completely lost the tax deduction for working with those professionals. Okay?
As a W-2 employee, or as a 1099.
Anyone. If you pay for it personally, it is now gone. Not deductible anymore. Yeah.
Unless you're 1099 though, right?
If you pay for it through the business.
Okay.
So if the business hires the CPA, you're good, right? Yeah. Perfect. Okay. The estate tax exclusion, the basic exclusion effectively doubled. It says 10 million here, it was a mistype. It's almost 11 million, 11.2. So one of the really nice things that we're seeing here is actually more gifting. Okay, so if you're having parents, grandparents, whatever, that are trying to get money out of their estate and give it to their kids, we're starting to see larger dollar limits being gifted to the children. So if your strategy is to go after people with larger sums of money who can potentially buy more property or whatever it is, start talking to them about their family members as well. Have you gifted any money to the kids? Are they interested in getting into real estate investing? Whatever it is, more likely than not, their estate attorneys are telling them to up that gifting program. Right? Get the money down to the lower generations, get it out of your estate while the limit is high. A lot of these new rules are set to sunset in 8 years, 2025. So a lot of people are trying to take advantage of this right now while it's still here. And who knows, if we end up with a new president, they could all revert like that, right? So it's one of those strategies, if you're in that position, if you're talking to those people, something they should be looking at. Okay. Child tax credit is $2,000, pretty much the same. Mortgage interest, this is a big one for you guys. In real estate, we've all seen homes. The mortgages are $1 million. They're, the big jumbo loans, right? They're $1 million, they're $1.5 million, whatever. Anything over $750,000 is no longer tax deductible. So you have, so you have a lot of people looking at, should I pay down debt, right? Pay off the mortgage versus doing additional investing, buying additional real estate. So it's one of the things that you guys might have to battle out on the streets when you're talking to your clients is, well, why should I spend my money here? I'm not going to get a deduction for it anymore. I'm in the 40% tax bracket. That could cause a problem. So the 750 limit is something to watch out for. Also, there's no more deduction on HELOCs, right? The home equity lines of credit. Those are completely gone. So your mortgage broker relationships are probably seeing a ton of refinancing to get rid of the HELOCs, get them over to traditional mortgages. Maybe people had splits, not anymore, right? They're combining into one. Okay. All right, and yay, the ACA penalty was removed. So anyone that doesn't have health insurance, no more penalty. Yay, that's a big one. Yeah, that one's just everybody's happy about that thing, so that's good.
Shauna, what was the mindset behind removing the HELOC write-off capabilities?
One of the biggest things that the government was seeing was people, and many people were doing it, right, is that they were refinancing their house, pulling it out to not work on the house, to buy a boat, buy a car, pay off credit card debt, whatever it was. That was not the original intention of allowing the deduction in the first place. They wanted people to remodel their homes, build value.
You could prove that money is used for a housing issue.
Correct.
If you can prove that, can you still write it off?
The better way to do it, there's argument right now. Let's put it this way. That particular issue is in the courts right now because, listen, I mean, my roof leaked. I had to get a whole new roof. Of course it's for the house, but this is the only way I could get the loan, right? So they're arguing that right now. If possible, try and stay away from it. But it's your call. Yeah, until the court cases are won. So this is another really good point. Nothing is ever set in stone. They make rules, then a bunch of people fight about it, and then we have answers. So always a good idea. Google is actually fairly accurate. Now, I'm not so sure I would trust, ABC whatever website, but if you go to the irs.gov, right, super useful. Their information is always up to date. You can also specifically pull tax court cases from NOLO law, which is really handy, and they're pretty accurate most of the time. Okay. All right. Or you can call a local tax goddess. Okay. Anyway, whatever's easier, you know. All right. So impacting your clients. So 1031 exchanges, we already talked about that. Make sure, of course, that you're using qualified intermediaries, right? There's companies that do 1031s. It is not smart to let your client try and do that on their own. We've seen too many cases where the IRS said, not a qualified intermediary, no, and the entire transaction becomes taxable. So be really cautious with that. Double check your entity taxation. Should you, at what point, if you're a sole proprietorship now, right, you're just starting in real estate, you've made $50,000, so your net profit after expenses is 20, right, you're just starting, sole proprietorship might be okay. Is it worthwhile, at what point should you move to an S Corp, to a partnership, you know, if there's a couple of you going together in something, at what point do you start changing your entity structure? The typical break-even point is when your company makes about $60,000 worth of profit. So, but of course, again, check with your CPA. You know, we talk about S Corps and partnerships here, but should you go to a C Corp? If you're making quite a bit more and you can get a 21% flat tax rate at a C Corp, is that better, right? What are the options there?
So 60,000 profit, you mean after the write-offs?
After the write-offs, after all the expenses. Yeah. Yeah, because that 50,000 is a single person, right? That 50,000 is your QBI. So once you've passed that 50,000 mark, that 60 is where anytime you change anything, let's start here. Anytime you get a good, you get a bad with the IRS, right? It's like the great evening scale, okay? So when you pass that 60,000 mark, if you decide to switch to an S Corp or a partnership or a C Corp, you're gonna have extra tax returns, you're gonna have payroll, you might have extra insurances, right? There's extra costs that come along with getting that tax benefit. So 60 grand is kind of the evening, you know, break even point of the cost versus the benefit on the tax side. Cool. 2 minutes. Okay, got it. I'll talk faster. HELOCs, we already covered. Investors, we talked about 1031s. So again, just directing them to make sure they're speaking with their CPA. In a perfect world, talk with them with their CPA. See if you can get in on a three-way call. A lot of times CPAs are not experts in real estate. You know, 40% of my practice is real estate, so I know you guys pretty well, all right? But there's a lot of CPAs that don't do that. So make sure you can get on a three-way call and at least question something if it doesn't sound right, okay? It's better to ask the question and be wrong. All right, strategies. If you guys ever need us, TaxGoddess.com, BigTaxDrop.com, and STC Lite. The primary thing that we do is create tax strategies for business owners. That's our gig. Last year, we saved over $26 million for our clients in tax savings. So I love what I do. Thank you. That's very sweet. Thank you, thank you. Tips and tricks, defer your income, retirement planning, AZ tax credits. Very last thing, I promise. AZ tax credits. Last year, the AZ tax credits allowed businesses to make contributions on behalf of their owners to the Arizona tax credits. At an individual level, that doesn't really work anymore. A lot of people are losing the benefit at the federal level because the itemized deductions have changed. At the corporate level, it can still be really, really good. So if you're looking to shelter $30,000, $40,000, $50,000 worth of Arizona tax credits, we're good there. And I hope you guys all have to shelter $30,000, $40,000, $50,000 of Arizona tax. Please. It depends now. You see, the answer is changed to it depends. If you, did you say you were married? I don't remember. Yes, okay, so if between you and your wife, you're gonna get over that $24,000, then yes, from a purely tax perspective, this is not talking about the benefits of making charity contributions, but from a purely tax perspective, if you're gonna go over that $24,000, do it. If you're not, don't. I mean, the charities are scrambling. As long as it's going to a qualified charity, it is. It's a question of whether or not you pass that $24,000. So it just depends on how much you're making.
Why is it
The itemized deduction limit has changed. It used to be like $6,000 per person, so husband and wife would be like 12. They've bumped it to 24 for a married couple. So let's say, for example, you're doing $10,000 of charity donations and you have no medical and $10,000 in property tax, you're only at 20. So the question is, from a purely tax standpoint, right? Not charity or any of the rest of it, from a purely tax standpoint, why would you give away $10,000 of your money if it's not getting you any benefit? Because the automatic is $24,000. Okay, so the charities are actually running into quite a bit of troubles trying to shift the way that they're marketing for money. Okay, any other questions? Because I know I'm way over. I'm so sorry. All right, fantastic. Well, if you guys need me, TaxGoddess.com, super easy to find me. I'll leave some business cards somewhere. Okay, I will leave them here on the front desk. I will leave them here. Yes, of course, feel free. Yep, that would be lovely. And actually, I would love to speak with any of you that have any questions. So I'd love if I could get an email list of everyone in attendance today. Would be lovely. Perfect. Rock on. Thank you so much. Yay.